Hello, I'm Robin Gibson, and this is the Harvard House Money Morsel. Good morning, welcome back. A very happy new year. As you may see, our studio has had a bit of a makeover, and today I'm sitting with Michael Porter, Chief Investment Officer of Harvard House. Morning, Michael. Welcome back.
Yeah, thanks you.
So, Michael, it's been the break over Christmas. 2022 is now in our rearview mirror, but we haven't done a Money Morsel since early December. So maybe you can just summarize for us how the markets ended and where we were at the end of the year.
Yeah, sure, Robin. I think everybody was hoping for a little bit of a Christmas rally, Santa Claus rally, as they call it. That didn't materialize, unfortunately, but markets were really strong in November. So maybe a little bit of reality sort of set in December.
Yes.
But actually might surprise people to know, Robin, that the JSE actually closed in positive territory for the year. 4.4% up if you measure it on the all-share Swiss index, which we think is the sort of most representative index. 4.4% up, and almost all of that, 4.3% of that came from dividends.
Wow.
Only 0.1% came from actual capital growth.
Yes.
Yeah.
Incredible. So, Michael, we're now rolling into a new year, and I guess one of the strange things is that we always, 2022, 2023, and we kind of think things should be different. But a lot of the issues from last year are rolling into the new year, aren't they?
Yeah, definitely, Robin. The issues that dominated last year, inflation, interest rates, and the concern about a recession this year are definitely still around. Quite a lot has sort of changed. On the US side, obviously oil prices have come back quite a lot over the last couple of weeks. And even South Africans will feel in their pockets that petrol prices went down $2.50 a litre or thereabouts yesterday or the day before, which is a welcome relief.
Yeah.
But yes, interest rates are still going to rise a bit further. Inflation hasn't really gone away, but we do expect it to moderate a lot. But there's a lot of concern around global recession this year and what's going to happen. But obviously what has happened over the last couple of weeks is China. And China's changed in terms of their COVID policy. So their COVID cases are going through the roof, but they're relaxing their COVID policies all the time. They're reopening. That's had a huge impact on a lot of Chinese-related equities, and it feeds through to things like Naspers and Prosus. China, having had a year or 18 months where it's actually been pretty slow growth, pretty muted because of their reaction to COVID, actually could have a much stronger year. And actually that could change the outlook for global growth considerably this year. Yes. Even if you look, Robin, globally last year, markets had a pretty poor show. The S&P was down 18%, the Nasdaq was down 30%. The FTSE, amazingly enough, was up a couple of percent, 3 or 4%. But that's also sort of the makeup of the index. But that whole tech bubble, if you look at the Nasdaq coming was sort of 30-35%. It might be interesting for people to know that from the start of 2020 to the end of 2022, that 3-year period, so just before COVID started to essentially the end of last year, the S&P and Nasdaq have delivered almost exactly the same performance.
Wow. So
that whole tech bubble has sort of come out of the system, which is, and I think, if you read Intuition this week, it really just highlights the risk of chasing past winners. Don't look in the rearview mirror to decide what's happening. You need to look forward. Yeah.
So, Michael, with the concerns around recession and inflation, that's still not clear where we're going. Does that mean we're going to still come into 2023 with a lot of volatility?
I definitely think so, Robin. Yeah, I think the first 3, 4, 5 months of this year could be quite volatile. I think actually as the year progresses, funnily enough, I think the markets will settle down a little bit because you'll start looking to 2024 where interest rates should definitely start falling. So the biggest risk for this year is that inflation doesn't moderate as fast as people expect and interest rates stay high for longer, or they rise further than what people are really expecting. So we expected the Fed to sort of peak in March, April time and for interest rates to be stable and then to start declining. But if that isn't the case, then markets can be a bit more volatile. Yeah.
And from a local perspective, obviously we came through the ANC election and Cyril hung on by the skin of his teeth, and it would appear that the RET faction seems a lot weaker. So does that kind of build into the base case of continued reform and kind of a slow, nothing ever happens quickly with our government, as we know, but a slow continued reform in some of these areas, electricity, those kind of things?
Yeah, Robin, I definitely think so. I mean, I think everybody is hoping that the pace of reform picks up, that Cyril's a bit bolder, we push through, have a cabinet reshuffle, maybe get rid of some dead wood. I think we're probably all a little bit sceptical, having had years of experience on this front. But definitely the trends that have been evident over the last year or two, it should remain. I mean, and electricity reform will continue. We're rolling out new power. So yes, we start the year with load shedding, which isn't great. We had load shedding over Christmas, but it all just, the pressure's just building and more on government to take some really decisive action and the private sector is just investing heavily and exponentially in power, So yeah, it's really frustrating, and for the little guy, it might be even more frustrating, little businesses, but big businesses are actively taking themselves off the grid, and that is essentially freeing up capacity for everybody else, So we do think there's a continuation of the same, Robin. And the JSE actually outperformed a lot of markets last year. It's surprising. Even in dollars, the JSE was only 0.8% down, which is significantly better than others. So listen, I think it comes down to valuations. Valuations aren't expensive. And I think, as we said on many occasions, Robin, I just think that SA is underappreciated. It's not that everything's going right down here. There's lots of issues, but the valuation relative to the prospects is not really in sync. And I think there's an underappreciation of just some of the resilience down here.
Awesome. Yeah, Michael, thanks very much. Well, keep tuned. If you haven't liked and subscribed, please do that. Click the bell so that you get a notification of when we release a new video. And we will be bringing you up to date on what's happening as they unfold into 2023. Thanks for joining us. See you next time.